can make their own decisions, and so that you know what the experiments are that are needed to be conducted. Not so I can spoon feed the alpha step by step. No one will do that for you. Implementation. This section implements a backtest for a basic taker version of the strategy. We will explore a few different days of interest and go from data scraping all the way to our P&L plot. For me, at least, the pipeline looks exactly like this every time. Data scraping, data pre-processing, analysis, continued, expanded analysis optional. In this case, I expect the analysis to be a basic opportunity test, and then from there, the analysis will develop a backtest. Then finally, we would do an expanded analysis which would include additional factors. Those additional factors would likely be latency or trading costs, which we vary to see the impact. Each of these 5 steps represents IPY notebook. The alternative for me would be an open PY file and start building tooling if I'm expecting this analysis to be more than just research. Other researchers need to validate my findings too. If it's going to take up lots of implementation resources like this strategy would, since lots of the alpha is on latency, data scraping, we'll be using tools like TARDIS as our data source. The most nice, dude. There's some alpha. Tick by tick order book snapshots. Cool, bro. Thank you. TARDIS. BitMEX, Deribit, Kraken, Binance. Okay. I wish I had access to some of these though. Okay, so he's doing some coding here. Half of these are default imports because the cost of importing is very low. And I typically copy paste the imports block from another block notebook. So realistically, there is no cost to importing libraries I expect to be using. Technically speaking, we can get away with just these. We're using Python, IPython environment. So we need to nest asyncio. JSON will be used to open source the JSON file with the TARDIS API key. The TARDIS dev is, of course, the TARDIS library for downloading. TQDM is a helpful library that makes the loops a lot easier to track the progress of. It's pretty helpful when you have hours-long downloads. We could end up using requests if we were fetching symbols from the exchange using, okay. Before we do that, let's define this. So we're doing some requests here, pulling some data. Data dog's gotta be a data dog. So these are the exchanges using Bybit, DYDX. For tickers, I also want to filter by market capitalization. So it's all crypto, which is cool to see. Now let's define our look back date, data types, and open our TARDIS key here. Time to scrape the data. Here's a big chunk of my code that I usually copy and paste about. So it's going through the exchanges and getting the data sets for each symbol. My download directory is specifically set up based on the structure of my research data on my laptop. You may ask, why not do it all at once with multiple data types and multiple symbols? Well, that's because it has a fit if you give it too much data to download at once, so I prefer to do it in smaller chunks. But it is really up to you to experiment with a bit more concurrency in your downloads. Don't worry. If you get a ton of these, it just means that the symbol isn't on that exchange, remember. All we need is for the symbol to be at a minimum of 2 exchanges. It doesn't need to be on all of them. You may also want to increase the date range we pull. I made mine short to save time, but I've used whole years for this kind of analysis in the past. I usually recommend doing a day and then going straight into writing the backtest code. Then you can rerun the data scraper to scrape more data. This prevents you from sitting at the desk reading the book paper whenever you do in this time because you can claim the data is scraping. Okay. Data preprocessing. Our data is normalized already because of the TARDIS formatting, but it's also GZ compressed and has a load of useless columns. Here's how we merge multiple exchanges. Okay, so this is nice. It gives all the code. I'm not going to read the code. This is pretty. If we run the code like this, exchanges and merge by bit. Okay. Merge exchanges. Then we should get this. Okay. We have two functions here. One merges TAQ, trades and quotes, on a per exchange basis, and another merges quotes cross exchange. We'll use the TAQ data for the limit under optimization analysis and the quote data for the initial opportunity exploration plus backtest. Our data appears to be processed, although our data selection is limited. Ignore the extra day I added. I scraped that after the backtest. A quick test in our notebook reveals this has worked properly. This is all satisfactory. On a further inspection, the data looks well formatted. If you want to open multiple of them at once, then you can use this snippet to aggregate them by date range. OS and pandas should be imported directly. So you need to import date time. Let's wrap up by talking about how the code works. We have decided to use quote data in our events, but typically we would have quotes and trades simultaneously and then fill forward only the quote values. We would loop through it by saying if the trade column is our choice our choice is non, then it's a quote update. And if it's not non, then it's a trade update. We're allowed to fill forward quote values, but not trade values. Once we get a quote message, we can assume that the quote is valid until the following quote is given. There are some very low latency issues here when you start to care about the sub 100 milliseconds, and especially the sub 30 milliseconds frequencies of data. Even order book events will be aggregated, roughly 30 milliseconds updates on Binance real-time updates, as long as you assume some decently sized latency between your deciding to make a trade and you actually simulating your fill. You should be fine. For context, we include trades in our data because trade data is very useful for a lead lag analysis, which we will discuss later. Volume plays a prominent role and at a very trade focused level still. We won't be implementing this, so I didn't feel there was a need. We do still need trade data, but not all the trades for all exchanges at once, since we estimate limit fill probabilities on a per exchange basis. Checking for opportunities. This motherfucker. I hate it here, dude. I hate it here. I can't believe this. I read like 45 minutes of this paper. Oh my god. I hate it here, bro. I'm not, I'm out. I'm out. I should have checked that first, dude. I should have checked that first.
Imagine you had everything you wanted. Everything. Imagine you were everything you ever wanted to be. And capture that feeling. That's the easiest way to manifest what you want.
That's killer, B. That's killer. That's killer, B. Come on. Give me all that. Let me have all that. Let me have all that. Please, please, please. Please let me have all that. Let me see it all. Let me see it all. Give me your all. Give me your all. I want your all, dude. The name of the article or the author? Yes, algos.org. and the author is Quant or Stat Orb. I'll put the link in the chat. The link is in the chat, dude. The link is in the chat. The link is in the chat. All right. We might hit a paywall for all these. Market making for dummies. Actually interested in this one, Psych. Part 2, okay. Okay, I mean, HFT research for dummies. Let's read through this a little bit. Today I'll talk about some general functions and activities in HFT research. It's not an all-encompassing guide by any means, but this tooling should end up being useful for you in your research endeavors. Certainly, these are common tasks I have encountered. Order book impacts, snapshot. Usually we just need to find out whether the strategy works in the first place, and we infer the capacity from the liquidity of the assets we trade. But in other occasions, we need to figure out the impact of a certain size on the order book, or otherwise use this data to find the capacity of the strategy itself. So TARDIS.dev is what he's using, dude.
Market data connection lost.
Market data connection loss.
Market data connection re-established.
You're welcome, dude. Start by pulling some data for USDT. So this shows you how to pull the data for Bybit. Okay, that's cool. Wow, that's a lot of data for 2 days. Anyways, we often need to find out the impact of our trades given a timestamp. This can fail when our size is quite large, however. At this point, we can either use the empirical data and then extrapolate from there by fitting the square root law. You can use the standard square root law, that's pretty accurate, or tune over a much longer horizon. I won't go into this too much, it's a dirty fix. We don't want to reconstruct the book on a live basis, which brings us to the next section. There are a few reasons to prefer the use of incremental order book data over snapshot data. It's far smaller to store on the disk because it avoids duplication. It comes from the feed that is typically slightly faster and would be the one used in production. It shows much more levels than the snapshot data. Continuing from our previous data scraping, we'll be using TARDIS with the same symbol in exchange. We can then go build and code to transform into snapshots, but generated live. When it comes to
I'm not
HFT
afraid
strategies,
to die on a treadmill. You might have more talent than me, you might be smarter than me, but if we get on the treadmill together, right, there's two things. You're getting off first, or I'm going to die. It's really that simple.
when it comes to HFT strategies, you often reach a point where latency cannot be ignored. Simply having great alpha and modeling is not enough. You also need to be competitive on the latency front. 777, Andre, good to see you. Most of this is concentrated on the cloud network engineering front, so let's implement some practical experiments. Ones that would typically be performed inside the top tier firms' latency research operations to develop optimal network setups. Why latency is key. Let's start by assuming a normal distribution for latency isn't and has quite the extreme tail. But this would only serve to further help our argument, so it doesn't match. Sorry, it doesn't matter much. We start by simulating a quick scenario. Given some reasonable network latency assumptions for a volatile market, how often does someone use 1 ms latency beat someone with 10 US latency? It's pretty clear that the improvement is quite minimal if 1 ms compute latency versus 10 US compute latency. Network latency can shoot up to hundreds of milliseconds in extreme scenarios, so having optimized network setups can keep your latency within normal ranges during this. This gives you an extraordinary edge that is practically impossible to beat with some sort of computing edge. Now, we'd be in a rough position if we had 10 ms compute latency, so if you are latency concerned, you will want to be using Rust or C++. But you won't be doing complex optimizations of your code like inequities. Instead, you will be doing complex optimizations of your network, which we'll cover in this article. All right. There's a wall. There's a paywall in all these. So, you know, this is interesting. Twitter, Reddit, data sources here. Tingo news data. In addition to being absurdly cheap, Tingo also offers an excellent API for news data. This is dope. Tingo news data. All right, this is fire. So I feel like this has been a good practice so far, dude. Sentiment data, reliable enterprise financial markets API. Let's see. I see our data in action. A few of our clients. Okay, Tasty Trade, Tingo News, Tingo end of day prices. Tingo's news feed are built over a decade with 50 million articles spanning 20 plus years. It could be good for sentiment data. Twitter, Reddit. I'm gonna start doing this with his articles because using Twitter normally requires Twitter API, and there's still an option if we particularly well-funded enterprise. However, markets tend not to react instantly to Twitter news, so a second latency isn't much of a problem. What's he using for Twitter data? Twitter scraper. How's he logging in? Oh, he's using the API key. Okay. Reddit has become quite heavily scraped in recent times, but alpha still remains, especially for digital assets where markets are far less efficient. In equities markets, that is much less the case, but in crypto, there still is a remaining degree of edge. Reddit offers a free API, but it has a limit. This isn't too much of a problem, but it means we will need to rotate keys. Create up 3 accounts, so with the creation, okay, Reddit could be cool as well. In our quest for alpha, we have two approaches. We need to compile a large-scale data set of data that has not been heavily analyzed yet, or we need to find our alpha by analyzing existing data that is already freely available. This is the difference between checking to see if Elon has talked about Doge and reacting rapidly. Well, we put a lot of work into analyzing a very small amount of data. Or on the contrary, we could be looking at Reddit's sentiment overall on a particular set of stocks. I already have an article on the theory of what works and what doesn't work when it comes to sentiment data. Today, we will focus on the practical elements of actually using this data. LinkedIn, Glassdoor, Yelp, Reddit. Interesting. Glassdoor could be cool. LinkedIn could be cool. Zillow. Here's a basic sentiment analyzer. So TextBlob is a way to analyze sentiment. Cheap GPT. If instead we value extremely low cost. Never. Okay, cool article. Thanks. Where's the edge? Could be a cool article. The CPI trade. Geographic arbitrage. That's funny. bribes and smuggling. Let's take an example of the Turkish lira. We start with USD, another highly liquid and easily transfer currency, JPY, UR, the euro or the GBP. The imbalance is typically created via a mass exodus from a certain currency to liquid international currencies. So in basically every case, we will be selling into international markets and buying local markets. You know, I'm not mad at him for having a paywall, dude. You gotta make people pay for your stuff, or else they don't take it seriously. Like me, dude. I'm not taking it too seriously because I haven't paid, so I'm just skimming. I think this was a good little overview. We got some good questions in the chat. I'm gonna think if I should bring this dude on or not. Yeah, he's pretty into HFT. I'm not really into HFT. That's the thing that's holding me back. But yeah, I appreciate him putting all this information out there. Much love to him. Much love to you. Hope you have just the most beautiful day ever. I've made hundreds of thousands of dollars with this trading bot framework, and I'm not only going to let you steal it, I'm going to help you master it in the next 15 days in the Algo Trade Camp. If you are a crypto trader who is ambitious, committed, and persistent, and you're typically good at what you do, but your trading results are just not where you want them to be, well, here's a quick question for you. How would it feel if you could have a trading bot that traded for you for the rest of your life, with or without you logging into the computer each day? You see, I'm just a regular dude, but for the last few years, I've been using trading bots to manage my admittedly low 7-figure personal portfolio, while others struggle with controlling their emotions, staring at the charts all day. When you meet me at the Algo Trade Camp, I'm gonna give you my exact blueprint. Look, we've all seen the countless ads, the cliches, the kids in the rented Lambos telling you how to trade. This isn't that. This is a proven trading bot system backed by real data and thousands of hours of research into automated trading systems. I put this system to the test using it to build a swarm of trading bots to manage my own personal portfolio. While I can't give you a plug and play, set and forget and make $1 billion overnight bot, I put my money where my mouth is, and I use this exact framework to build all of my trading bots. But look, you've seen trading bots in the wild, you've heard of successful algo traders, and you hear of quants that have become wildly successful and make crazy money, so you know it's possible to automate your trading. And you're watching this video right now, so I know you're super smart, because searching for a better, more efficient way to trade, that's just something smart people do. And because you're smart, you also know there's a little something extra. You know there's a little piece of magic mixed into all of it. Now, I know what it feels like, dude. Not just to not make money trading, but to lose money due to emotions or just my poor human judgment. Everything else I could just work harder at and I would get better, but for trading, for some reason, I could never get over the emotions. The times where I'd be up all night staring at the charts, just hoping it would go my way, just to fall asleep to a liquidation email. When you know you're ambitious and you're extremely persistent, but you just can't figure out the game of trading, and to feel like, dude, I'm never gonna stop trading, but I keep losing. Look, I get that. It's normal for manual traders, hand traders, lose money. Remember, 95% lose. I want to take you from that feeling of losing due to emotions to being a dominant force in the crypto market. I want to help